Hello and welcome to the asset management update. That's Uptown Syndication. My name's Chris, and we got Trent and AJ here. I need to change my name to Chris.
Hey, everybody.
How's it going? We are chatting about the Summerfield Loop townhomes. We bought this property in 2023, and we're on, the third year of operation. We've owned it for 2 years. And so we're going to take a peek at the financials and have a look at the rent roll. And yeah, Trent, do you want to just chat about this particular property just in general so we can kind of get a little understanding of how it's operating and what's going on with it?
Yeah, absolutely. I'm sure everyone knows that it's 6 duplexes, so 6 roofs, 12 garages, a bunch of different systems and fixtures across 6 different duplexes. Since we owned it, I think we've replaced 3 roofs at this point. We've done 3 unit turns as well, interior unit turns as well. Done some fascia repair that was required by the lender, whether that be replacement or just painting, chipped paint, peeling paint. We've also done front hand railing repairs that were required as well. And we replaced one of the backyard decks that desperately needed to be replaced. We currently have a couple of turnovers ongoing right now. These are recent move outs, so we need to figure out what the scope of work is going to be for the interior renovations there. And yeah, we've definitely been able to increase rents when we have released units, whether they were renovated or unrenovated. We've definitely been able to drive the income up at this property. From what I know, we'll look at the numbers, but from what I know, we've been able to increase the revenue there pretty well.
Okay. Well, let's dive into the P&L and just see how we are comparing to pro forma at the moment. So if we look at the total income for the property over the past 12 months, we're looking at August 24 to July 25. We're at 330,000 of income. And if we take a peek at our pro forma, for year 3 is 335. I actually edited this pro forma. Yeah. So these are the actuals for last year. And this is the projected for next year. So I guess let's compare it to next year. So
can you look at the version history?
Yeah, I can look at the version history. Okay. Yeah, so we were projecting 10% vacancy as we stabilized in year 2. So 282,000, and I believe I just said we were at 329. And then in terms of expenses, 103,000. Expenses were 93. So we're kind of knocking it out of the park based on our projections. We did project that we were not going to be dispersing all of our preferred returns in the first 2 years. Honestly, the first 4 years, because of the refinance, we were not expecting to be paying the full preferred return. Not until the last year. And so, but it does seem like we are going to be getting much, much closer I'm gonna go back to my updated version. So this has been updated with years 1 and 2, and we have been pretty close to paying. I think that's about 5% of the preferred return. And yeah, is Nicole, our operations manager. Okay, so net operating income 236,000. Let's just look at year 3. We were planning on 226,000, so we're ahead of schedule by 10,000 for year 3, and we're less than a year and a half in, or 2.5 years in. So that's looking very good. And these numbers are looking good, and I expect this number to look even better. And so now we're kind of weighing the decision of whether we're going to refinance the property or not. And yeah, let's have a peek at the rent roll. We do have 2 vacants currently, so that is a little bit concerning. We did just have 1 tenant who was going to move out decide to not move out because she couldn't find anything comparable. So that was encouraging. And yeah, I mean, renting has just been a little bit tougher this summer. AJ, do you want to kind of touch on that a little bit?
I mean, I believe that one of the units has been vacant for 8 days, and then the other one is like 22 days. So, they're very recent. We've actually experienced quite good vacancy, meaning like low vacancy for this asset for a while. So that's been encouraging. That's why it's probably overperforming. Yeah, Chris, what did you want me to touch on?
Just kind of vacancy this summer. You know, we're kind of noticing that rents have been a little bit flatter. I guess Happy Valley has been a nice pocket where rents have been increasing.
You know, we got the highest achieved rent that we've ever gotten. I think it was 20, is it 25, 22? Is that right?
2665 is the highest achieved.
So, I mean, that's super encouraging. It means that there's potential rent growth for
that tenant's moving out.
Yeah.
So, I do think we have some rent increases going in, though. Yeah, we have a tenant with a rent increase that is going to 2770. And then one of the tenants who's on a little bit lower rent is moving up to 2412. So, you know, we're systematically getting closer to market rents at these properties. And yeah, it's encouraging.
Overall, Portland market from 23 to 24, summer of 23 to summer 24, we actually saw a rental decrease. So with some of the other properties, it's affected them a little bit more. I think these are a little bit higher end units. And because of the large nature of the units, they didn't see as much of a decline. And also because they were already under market. So didn't really affect this property that much. But, you know, Portland, we've got 2 to 3% jobs growth, 2 to 3% overall population in migration. So there was something that the governor and the city mayor decided is they're going to do 5,000 5,000 units are to start. They're going to waive the SDC fees. And the reason they're doing this is that there is like literally no construction in Portland. Nobody really wants to develop. So when that happens, the existing supply and kind of there's about 3 to 6 months of the projects that were already in the works that are kind of finishing up. So once that gets absorbed in the market, because of the net in migration, that means the supply goes down and the demand's going to go up. So in the next 6 months to 24 months, we anticipate there being more demand on rent, which is one of the reasons we're very bullish on getting into new properties and holding on to the ones we got.
Okay. Let's
So
look
I
at
saw
the,
Ray. I saw Ray had his hand raised. Ray, did you?
Ray, you got a
yeah,
question?
go ahead.
I did. Going back to when you were talking about refinancing, can you refinance at a better rate than what's currently in place?
No,
Oh, okay. Problem solved.
but pretty close.
Okay.
So Chase has a program that would give us interest only for 5 years, at around 5.7%. And here is our current mortgage. So we're at 5.45. But,
Yeah.
we've got, yeah, we wouldn't save that much on the
Right.
principal.
Chris, we'd get proceeds
Couple
back
thousand.
from the refinance because we've
Right.
increased the NOI, and then we'd be passing that back to investors, right? Catching up on
Yeah.
the preferred return.
Essentially, I've got the refinance modeled out right here. At a 2.53 million loan, or loan amount. And this is with the Chase loan. The fees are really low. We do have a $20,000 prepayment penalty,
Right.
but we'd be able to pay, roughly a third of the funds back to investors and catch up any preferred return. And so, based on and even with this appraised value, like I think that each of these townhomes are worth, between $400,000 and $425,000 each. And that has always been in the back of my mind as a, exit plan for this property. And so I guess that's another question to weigh too, is how exactly do we want to exit from this property? Because, potentially we could just sell 6 of the units right now and pay off the loan, and then we'd be free and clear. And then we could sell them off kind of one by one and pay pay dividends out.
But then what about the HOA fees for, are they condos or townhouses or
There's no
I don't know.
HOA. They're duplexes.
Oh, they're duplex. Okay.
Yeah.
Okay.
They're townhome duplexes.
Right. With no HOA. So yeah, it's not like we're absorbing fees for the ones that quote unquote we own. Okay. Thanks.
I mean, technically, I think you're part of the HOA because we're the HOA, right?
No, correct. Correct.
We're covering all exterior maintenance and grounds and all of that fun stuff.
Right.
Ben?
Yeah, I may have missed this, but I was just curious if you could share with us a little bit about what the reason would be for the refinance. Is that just a requirement of the loan term, or why wouldn't we just stick with the mortgage that you got?
So essentially it's return on equity. We have increased the property value. And the reason why we would refinance is to essentially improve returns so that the money that is locked up in the deal can be made available for other deals while, still, the property is still growing in value. Like it hasn't reached its full potential. We expect the property to increase in value to 5.3 million. Roughly, what is that? $430,000 per door. Something like that. Which I don't think is crazy. That's not crazy. Like that might be its current value now. And so getting the funds so that they can be placed back to our investors so that they can be invested and into new investments where it can grow. It's, everyone's still going to retain their ownership value. We just want to return capital while you still earn, while this investment still grows in value. Like we want to, that's how we maximize the IRR for our investors.
Okay, no, that's helpful.
And Chris, the return of that money, it's loaned money, so that would be non-taxable, right?
Yeah.
So, the investor would get back, you said 20 to 40% or so?
We'd be looking at 571,000 cash flow. We do have some preferred return that needs to get caught up, so wouldn't pay down the equity that much. Or sorry, I think let me look right here. So cash flow paid to investors has been 130, and we're at 1.465 times 0.07 is, well, that's not what I want. The preferred return is,
You're looking for the annual?
yeah, the annual preferred return is 102,550.
80,000 would need to get caught up over the 2 years.
We'd be returning probably about a third of initial capital invested.
So about 30%. So if you invested 100K, we'd be getting back 30K tax free, able to go invest it into another deal or tax free. We do not suggest buying boats.
No, that's helpful. I appreciate it, guys.
Yeah. So I think that is basically what we wanted to share. There's a couple loan programs. There's another loan program that's a little, where we could buy down the rate, and get more proceeds, but it's you have to pay, points and whatnot to do that, and so it's kind of a wash on the proceeds. So I don't love it that much. I think the Chase loan program is great, but all in all, yeah, and maybe we see rates come down a tiny bit. If we can refinance at the same rate, then that would be pretty interesting. So
Any capital improvements coming up that might need to be done, or are we pretty much caught up on all that?
The property is exactly 30 years old. So, and we got it pretty original from the builder. So we've done a couple roofs, a couple water heaters. We haven't done any furnaces yet, have we?
I think there might be one.
We've done one furnace, but basically we, anything could break at any moment. So we are, I think looking at the loan, there is about $6,000 in the reserve account balance that I need to ask about. Because they're collecting $250 of reserve every month. And then as well, we did get a good insurance quote for, I think, where's the insurance? I think it was only $6,000. And we're paying, I think, $7,800 right now. So couple little things to improve the P&L. But I mean, honestly, what we've been talking about Portland is rents have basically stayed flat, and with just the expectation that they're going to go up eventually. Like we're going to see increases in rents and increases in demand. Once all of the units that got built during, that got started in 2021 and 2022, and now they're all getting delivered. Eventually, those will all get absorbed and Portland will, have a housing shortage. But there's not a housing shortage right now. Like we've got a little bit higher vacancy than normal. So yeah, I expect rents to go up. Cool. Anybody else have any questions? Mark, Danny, I think that there were a couple questions that got emailed in.
Yeah, I had 3 questions. I will be honest, I can't remember all of them. But I think it was basically just kind of, this is my first time going through this process. So just, let's see here. Yep, 2 to 5 year plan, current exit strategy, which you've already talked about pretty much.
Yep.
And then what to expect at the end of the project. This is my first time. So is it like a paperwork? Is it just a check? Is it how does all of this unwind?
Well, we're actually going through this on our first deal that we got into contract, or that we set up in 2019. We're selling it right now. And so there's generally a couple options. One is that you can take the money and pay taxes on it. And the other is you can decide to stay with the syndication and 1031 exchange forward into our next investment, if it's available. So, I mean, our goal is to always have the next investment available. Like I call an investment like this a golden goose, and you can keep earning the 12 to 20% IRR forever going forward, and then just kind of live off that preferred return. And if you look out at it like 5, 10, 15, 20 years, it compounds exponentially, and that preferred return looks pretty amazing if you can keep 1031 exchanging it forward. But back to your question, if you decide to pay the tax and take the money, we'll drop you out of our LLC and into a tenant in common. And so however you signed up for the syndication, we'll just have you be a tenant in common on title at closing, and then you'll just get either a check or a wire from escrow, and you will be responsible for essentially paying the taxes on it.
Sure.
And doing the taxes on it. Like we'll do all the bookkeeping. So we'll give you your prorated numbers like income and expenses, but then that's gonna basically, you'll need to plug that in, either have your CPA plug it in or Schedule E for your taxes.
Sure. But so with that then
changes from being a K1 to now you're a tenant in common.
Right. Okay. And so with that then though, but the goal of this whole process is that there will continually, hopefully be another, in terms of timing, there'll be another property to then 1031 into. And so that's the goal.
Yeah,
That's the goal.
We want to keep that golden goose alive.
Yeah, which I'm fine with. I like to hear that.
Well, and then the thing is too, is that once the golden goose starts getting pretty big, the 7% preferred returns are, like meaningful, when it's just, a first small investment, but when that small investment doubles and then it doubles again, now, that preferred return is doubling and doubling and doubling.
Sure.
And that it gets pretty interesting. And as well, when it comes to estate planning too, if you just keep it going, your heirs will inherit a stepped up basis if you never sell it. So
they're on their own, but okay.
Well, a charity could inherit a stepped up basis.
No,
So,
it's all good. But no, thank you. That actually helped a lot. Like I said,
Yeah.
just because this is my first time going through it, I wasn't sure what the typical ending was exit of this. So no, that helps a
Mhm.
lot. Thank you.
cool. Well, yeah, I guess for your first question about what's, 2 to 5 year plan, we're looking at refinancing. I believe the property is in great shape. Like we're ahead of schedule on the NOI. And so I'm hoping, we projected out that preferred returns were going to be slightly shorted, but I'm hopeful that we'll get to it. So yeah.
Cool.
Okay.
Well, thank you, everyone. Thanks for showing up and asking some questions.
Yep. We will get the recording posted and have a great evening. Happy Thursday.
Thanks,
Yeah.
gentlemen. This is
Thank
helpful.
you, everybody.
Bye-bye.
Good job,
Adios.
guys. See y'all.